China just pulled the trigger on one of the most dramatic moves in global commodity markets. In late September 2025, China Mineral Resources Group ordered Chinese steelmakers to halt all purchases of BHP iron ore cargoes. And this isn't just about one company. This single decision sends shockwaves through Australia's entire $120 billion iron ore export industry. What does this mean for Western Australia's Pilbara region? How will this reshape the global steel supply chain? And most importantly, could this be the beginning of the end for Australia's iron ore dominance? Here's the reality that nobody's talking about. This ban didn't come out of nowhere. It's the culmination of years of tension over one critical issue: who controls iron ore pricing? And the answer to that question will determine the future of Australia's economic prosperity. Let's rewind to September 2025. Bloomberg breaks the news. China Mineral Resources Group, the state-run iron ore buyer created by Beijing specifically to consolidate purchasing power, instructs major steelmakers and traders across China to temporarily suspend purchases of any dollar-denominated seaborne cargoes from BHP. Not just one product, all BHP iron ore shipments. The ban applies to new contracts and shipments already departed from Australian ports. Only small volumes of BHP cargoes already landed in Chinese ports remain tradable. The market reaction? Immediate. BHP shares plunged to $42.05 on the morning of October 1st, closing at $41.50. Australian Treasurer Jim Chalmers scrambled to arrange meetings with BHP CEO Mike Henry. Prime Minister Anthony Albanese called the situation disappointing and demanded quick resolution. But here's what makes this absolutely critical. Iron ore represents nearly 60% of Australia's exports to China. This isn't wine or barley from the 2020 trade disputes. This is the backbone of the Australian economy. Now here's where things get even more interesting. This wasn't China's first shot across the bow. Back in September 2025, China Mineral Resources Group had already urged domestic steel mills to cease purchasing BHP's Jimblebar fines, a premium high-grade ore with 65% iron content. Industry sources reported that 3 vessels carrying Jimblebar fines that arrived at Tianjin port were held back from clearance. Electronic systems at Hebei steel mills literally stopped allowing procurement managers to order Jimblebar fines. The message was clear: Beijing was testing its leverage. But then in November 2025, China expanded the ban even further. The directive widened to include BHP's Jingbao fines, a low-grade ore product. This escalation proved Beijing wasn't bluffing. They were systematically applying pressure across BHP's entire product range. So what's really driving this standoff? The answer lies in something called the Platts benchmark pricing system. For decades, iron ore prices have been determined by indices managed by S&P Global Platts. BHP insisted on an annual pricing model anchored to the 2024 Platts average of $109.50 per metric ton, but Chinese buyers demanded quarterly terms linked to spot market levels. Why does this matter? Because China consumes 70% of the world's seaborne iron ore, but has virtually no say in how prices are determined. Chinese commentators in China point to a fascinating conspiracy. They note that J.P. Morgan is both a significant shareholder in BHP and an influential player in shaping the Platts index. Can such a pricing system truly be fair when Western capital controls the benchmarks for a commodity that China desperately needs? Chinese commentators argue that mining costs for Australian iron ore are only slightly over $10 per ton, yet the mineral is priced at approximately $130 per ton based on Platts benchmarks. That's a massive markup. Let's understand the scale of what's at stake here. BHP supplies approximately 250 million tons of iron ore annually to China. That represents about 21% of China's massive 1.2 billion ton annual import volume. To put this in perspective, BHP's Western Australia iron ore operations produced a record 263 million tons in fiscal year 2025. Their Pilbara hub set multiple production records, with the South Flank mine exceeding nameplate capacity in its first full year of operation. The timing of this ban is absolutely strategic. China implemented it in Golden Week, the October holiday period, when markets typically experience a seasonal slowdown. It maximizes negotiating pressure when trading activity naturally lulls. It's calculated, it's deliberate, and it reveals Beijing's sophisticated approach to commodity manipulation. Now here's where the plot thickens. Who benefits from this ban? Brazil's Vale immediately becomes the winner. As BHP cargoes are blocked, Chinese buyers frantically seek alternatives. Vale stands to capture significant market share alongside other suppliers from Africa. But there's an even bigger story unfolding: the Simandou iron ore project in Guinea. Simandou is a game changer. This West African mine is expected to ship its first cargo in November 2025 and will eventually deliver 120 million tons of iron ore annually. That's approximately 10% of China's total annual imports. The project involves massive Chinese investment, including partnerships with China Baowu Group. Once fully operational, Simandou fundamentally alters the supply-demand balance that has kept Australian miners in a position of strength for decades. Think about what this means strategically. For years, China felt vulnerable because Australia, particularly BHP and Rio Tinto, controlled the supply. Hundreds of Chinese steel mills negotiated separately with the major miners, who spoke with one unified voice. But in 2010, BHP's then CEO, Marius Kloppers, led a push to replace annual price benchmarks with shorter-term market-based pricing. This change supercharged profits for Western Australian producers, who could capitalize instantly as China's demand surged. For China, it was a nightmare: less control, more volatility, bigger bills. The creation of China Mineral Resources Group in 2022 was Beijing's strategic response. This isn't old-fashioned central planning. This is state capitalism with sharper tools: centralized buying, strategic stockpiling, and big data analytics to support national economic goals. The purpose is crystal clear: transform China from price taker to price maker. But here's the uncomfortable truth that Australian mining executives don't want to discuss. Australia and China rely on each other, but not in equal amounts. Australia is critically dependent on China for revenue. Iron ore exports to China were valued at over $100 billion in 2024. Meanwhile, China, in the short term, still depends heavily on Australian ore, but that dependency is rapidly changing. Let's examine the numbers that reveal Australia's vulnerability. In 2023, iron ore exports to China amounted to around 115 billion Australian dollars. China was by far the leading export destination for Australian iron ore. According to shipbroker Banchero Costa, in the first 9 months of 2024, China received 83.8% of iron ore shipments leaving Australian ports, totaling 579.6 million tons. The next highest importers were Japan and South Korea, with just 39 million tons each. By November 2024, shipments from Australia to China reached 711 million tons, absolutely dwarfing the 251.8 million tons of imports from Brazil. RBC capital markets analysts initially viewed the ban as a negotiating tactic, an effort to secure lower long-term prices. They argued that if Chinese steel mills were pushed to buy from Rio Tinto, Vale, or Fortescue, cumulatively it would cost them more and be less efficient. This would likely increase the miners' pricing power as steel mills compete for limited feedstock. But this analysis misses the bigger strategic picture. China is playing a long game. The immediate market impact tells us everything we need to know about how serious this situation is. Forward freight rates for capsize bulk carriers, the massive vessels exceeding 150,000 deadweight tons used primarily in the iron ore trade, ended a 6-day losing streak when BHP appeared to request 2 capsize carriers for delivery to China 2 weeks after the ban, but uncertainty remained. Were these orders placed before or after the ban implementation? Here's why shipping markets matter so much. Capsize vessels are heavily dependent on iron ore cargo. When a buyer as dominant as China alters purchasing patterns from a supplier as significant as BHP, ripple effects through shipping markets are immediate and pronounced. The extreme sensitivity reveals just how interconnected the entire iron ore supply chain is. Now, let's talk about what's happening in the Pilbara, the heartland of Australian iron ore production. This region in Western Australia isn't just important, it produces ore that Rio Tinto literally calls the world's most recognized brand of iron ore. The Pilbara hosts integrated systems of mines, rail infrastructure, and port facilities that represent billions of dollars in capital investment. BHP's Western Australia iron ore operations include an integrated system of 4 processing hubs and 5 iron ore mines connected by more than 1,000 kilometers of rail infrastructure. At each processing hub, Newman, Yandi, Mining Area C, and Jimblebar, ore is crushed, beneficiated where necessary, and blended to create high-grade hematite lump and fines products. Iron ore products are then transported along the Port Hedland-Newman rail line to port facilities at Port Hedland. The company's performance in 2025 was extraordinary. Record iron ore production driven by operational improvements, debottlenecking exercises that eliminated production constraints, and the successful ramp-up of the South Flank mine. South Flank alone added approximately 80 million tons of annual production capacity, featuring higher-grade ore with 62% iron content, a premium product commanding higher prices in global markets. But here's the problem. All of this production excellence means nothing if the primary customer refuses to buy. BHP had projected iron ore production guidance for fiscal 2026 at 284 to 296 million tons, indicating anticipated production increases of up to 2% year over year. Those projections assumed continued strong demand from China. With the ban in place, where does all that ore go? The answer isn't simple. Japan, South Korea, and emerging Asian steel producers can absorb some additional volume, but they can't replace China's massive consumption. Europe is transitioning toward direct reduced iron production using green hydrogen, which requires even higher grade ore than most Pilbara production currently offers. India is boosting its domestic steelmaking capacity, which means it's actually reducing iron ore imports rather than increasing them. This brings us to a critical inflection point for Australian mining. The China ban forces a fundamental reckoning. Can Australia continue to be merely the world's quarry, shipping raw materials with minimal value-added processing? Or must the industry transform toward producing higher-value products like green iron and processed materials for electric steelmaking? Prime Minister Albanese, during his visit to Beijing earlier in 2025, pitched a vision for Australia to move beyond exporting raw ore. Instead, the proposal involves selling green iron, an intermediate product on the path to green steel. With Australia's vast renewable energy resources, particularly solar and wind in Western Australia, the country could potentially climb the value chain rather than remaining locked in commodity price competition. This aligns with China's own carbon-neutral goals. Traditional steelmaking is one of the world's dirtiest industries, relying on coal, which pumps out carbon emissions. The next frontier is green steel, made with renewable energy and green hydrogen instead of coal. If Australia can position itself as a supplier of green iron rather than just raw ore, it creates an entirely different strategic relationship. But there's a massive challenge. Investment in renewable energy infrastructure and hydrogen production facilities requires substantial capital. Projects like Fortescue's Christmas Creek Green Iron Plant in the Pilbara, targeting first production in 2025, demonstrate the potential. But scaling this across the entire industry? That's a multi-decade, multi-billion-dollar transformation. Meanwhile, competitors aren't standing still. Vale announced in February 2025 a significant investment of $12.26 billion in its Carajás complex in Pará, Brazil. The investment, deployed through 2030, aims to boost annual iron ore production to 200 million tons while expanding copper output by 32%. Vale is simultaneously pursuing blending strategies, combining high silica ores at Chinese ports to meet specific market preferences. The geopolitical implications extend far beyond commodity markets. Iron ore has largely remained insulated from previous Australia-China trade tensions because of China's heavy dependence, but Beijing's willingness to weaponize even essential commodities signals a fundamental shift. This marks a new phase in the complex economic interdependence between the two countries, with potential long-term structural impacts. Consider the broader pattern. In 2020 and 2021, Beijing targeted Australian exports, including wine, barley, and coal, during diplomatic tensions. Wine exports to China essentially stopped. Barley faced prohibitive tariffs. Coal shipments were unofficially blocked. But iron ore remained untouched because China had no viable alternatives at the required scale. The establishment of China Mineral Resources Group changed that calculation. By centralizing purchases and building strategic stockpiles, China created the flexibility to withstand temporary supply disruptions. Steel mills were instructed to utilize existing inventory first during the ban period. A Guangdong-based writer noted in September 2025 that talks between CMRG and BHP had been stalled since May. The ban was months in the making. Here's what industry observers find particularly revealing. The ban specifically targets dollar-denominated seaborne cargoes. This isn't just about iron ore pricing. It's part of China's broader strategy to internationalize the yuan and reduce dependence on dollar-based trading systems. BHP's first shipment of renminbi-based spot trade iron ore docked in Shandong province in July, demonstrating the company's willingness to accommodate China's currency preferences. But apparently, that wasn't enough. The stakes for regional communities in Western Australia are enormous. The Pilbara region's entire economic ecosystem revolves around iron ore mining. Towns like Port Hedland, Karratha, and Newman exist primarily to support mining operations. Employment, infrastructure, services, everything depends on continuous production and export. A prolonged disruption in Chinese purchasing doesn't just affect BHP's profit margins. It threatens the livelihoods of tens of thousands of workers and their families. State governments in Western Australia have long relied on mining royalties to fund public services. The 2022-2023 state budget showed iron ore royalties contributing billions to government revenue. Any sustained reduction in iron ore exports directly impacts the state's fiscal capacity. Schools, hospitals, roads all face funding pressure if the iron ore boom falters. Now let's examine what this means for BHP's competitors in Australia. Rio Tinto and Fortescue are watching this situation with a mixture of concern and opportunism. On one hand, if China successfully pressures BHP into accepting less favorable pricing terms, it sets a precedent that affects all Australian miners. CMRG could then turn the same tactics on Rio Tinto or Fortescue, demanding similar concessions. On the other hand, during the ban period, Chinese steel mills still need iron ore. If they can't buy from BHP, they turn to Rio Tinto and Fortescue, potentially increasing demand for their products. Rio Tinto shipped approximately 97.8 million tons of Pilbara blend fines in 2024, down 7% from 2023 due to weather disruptions and mine transitions. Additional Chinese demand could help offset those production challenges. Fortescue, as a pure iron ore play, is even more exposed to Chinese market dynamics. The company posted a 53% profit plunge in the first half of fiscal 2025, reflecting the brutal impact of declining iron ore prices. Any disruption that further pressures prices or market access poses existential risks. Fortescue has been pursuing aggressive diversification into green energy and hydrogen, precisely because relying solely on iron ore sales to China has become increasingly precarious. The technology dimension of this story deserves attention. Australian miners have invested heavily in autonomous haulage systems, robotic ore sampling, predictive maintenance using artificial intelligence, and digital twins of processing plants. BHP's Pilbara operations now feature autonomous haulage systems across 65% of the fleet. Upgraded rail loading systems have reduced cycle times by 15%. These efficiency improvements allow Australian miners to remain cost competitive even as prices fluctuate. But technology can't solve a market access problem. The most efficient mine in the world still needs buyers. And when your primary buyer is a centralized state entity pursuing strategic objectives beyond simple commercial transactions, all the operational excellence in the world provides limited protection. Let's talk about what happens next. As of late 2025, negotiations between BHP and China Mineral Resources Group remain ongoing. Neither party has provided official public comment, which suggests talks are continuing behind the scenes. Industry sources indicate that the ban functions as leverage to force BHP toward quarterly pricing linked to spot markets rather than annual pricing linked to Platts averages. If BHP capitulates, it establishes a new pricing paradigm that fundamentally shifts market power toward buyers. Chinese steel mills would gain significantly more flexibility to adjust purchases based on real-time market conditions. This would reduce their exposure to price volatility, but would correspondingly reduce pricing power for miners. However, if BHP holds firm, betting that China ultimately needs Australian iron ore more than BHP needs Chinese customers, the standoff could persist for months. The company has already announced cuts to exploration spending after annual profit fell to its lowest in 5 years in 2024. Prolonged revenue disruption from the Chinese market would force even deeper cost reductions. There's also a scenario where compromise emerges. Hybrid pricing mechanisms that incorporate elements of both annual stability and quarterly flexibility. Payment in yuan rather than dollars. Technology partnerships on green steel development. Strategic investments by Chinese companies in Australian mining projects, similar to the Rio Tinto China Biowu joint venture on the Western Range project. The Western Range project is particularly instructive. This $2 billion high-tech iron ore mining operation, jointly owned by Rio Tinto at 54% and China Biowu Steel Group at 46%, started full production in 2025 with an annual capacity of 25 million tons. Rio Tinto's CEO called it symbolic of the depth of connections between ourselves and our friends in China. This model of joint ownership and shared investment creates mutual dependencies that make outright trade bans less likely. Could BHP pursue similar partnership structures with Chinese steel companies? It's possible, but it requires BHP shareholders to accept reduced control and profit margins in exchange for market stability. That's a difficult sell when the company has built its business model on maintaining pricing power through consolidated supply. The iron ore price dynamics throughout 2025 tell their own story.
After starting 2024 at a high of $144 per metric ton, prices slid to finish the year around $95. A cyclical rebound in Chinese steel production in Q1 2025 pushed prices back above $100, briefly touching $107 per metric ton in February.
However, by Q2 2025, China's economic challenges, growing surplus in global supply, and steel tariffs pressured prices back below $95. Industry analysts note that iron ore prices have shown remarkable resilience compared to other commodities, remaining within a $96 to $110 per ton range since late 2024, despite geopolitical tensions. This stability reflects improved investor sentiment following tariff reductions between major economies and expectations of increased steel demand. But oversupply concerns loom large. The Simandou project in Guinea represents the single biggest threat to Australian iron ore dominance. When fully operational, this mine will produce ore comparable in quality to Pilbara products, but located much closer to European markets. Its 60 million tons of initial annual capacity, eventually scaling to 120 million tons, enters a market already struggling with oversupply. Market participants expect additional low-grade and high-grade iron ore supplies throughout 2025 and 2026. Mineral Resources' Onslow Iron Project in West Pilbara and Phoenix's Shine Iron Project, brought back into production in late 2024, add even more Australian supply. The fundamental supply-demand equation is shifting against sellers. In this environment, China's leverage increases dramatically. Why pay premium prices for Australian ore when abundant alternatives exist? Why accept annual pricing when spot markets favor buyers? Why tolerate pricing mechanisms controlled by Western financial institutions when you're the dominant purchaser? These questions drive China's increasingly aggressive negotiating stance. The green steel transition adds another layer of complexity. Europe is leading the shift toward direct reduced iron production, with DRI output projected to reach nearly 40 million tons by 2035. This process requires significantly higher grade iron ore than most Pilbara production. As steelmakers transition to DRI, global demand shifts toward premium high-grade ore and away from the mid-grade products that constitute the bulk of Australian exports. Rio Tinto is preparing for this transition by planning to blend Simandou's high-grade ore with Pilbara supply in China. This strategy manages market dynamics as the industry transitions toward lower-emission production methods. BHP faces similar adaptation requirements, but with the added complication of the current ban creating uncertainty about future market access. The human element of this story can't be ignored. Behind every production statistic and pricing negotiation are workers, families, and communities whose lives depend on the iron ore industry. Pilbara towns experience boom and bust cycles tied to commodity prices. During boom periods, fly-in, fly-out workers earn substantial wages, local businesses thrive, and property values surge. During busts, employment evaporates, services contract, and entire communities face existential threats. Indigenous Australian communities in the Pilbara have complex relationships with mining companies. Traditional owners hold native title rights over vast areas where mines operate. Mining agreements provide employment, royalty payments, and funding for cultural heritage programs. But they also bring disruption to sacred sites, environmental degradation, and social challenges. A major contraction in mining activity would devastate indigenous community economies that have become dependent on mining revenue. Environmental considerations loom increasingly large. Iron ore mining involves massive landscape transformation, open-pit mines, tailings dams, infrastructure corridors through wilderness areas. As global attention focuses on environmental, social, and governance factors, Australian miners face pressure to demonstrate responsible practices. Climate activists question the sustainability of exporting materials used in carbon-intensive steel production. The counterargument points to Australia's relatively strong environmental regulations compared to some competitor nations. Australian miners increasingly emphasize their commitment to rehabilitation, biodiversity protection, and partnerships with traditional owners. They argue that if Chinese and global steel demand continues, production will occur somewhere. Better that it happens in Australia with strong oversight than in jurisdictions with weaker standards. But this argument provides little comfort when facing a ban. China's willingness to forego Australian iron ore, even temporarily, suggests environmental considerations are secondary to strategic objectives. Beijing calculates that diversifying supply sources, even at some environmental or economic cost, reduces long-term vulnerability to Australian dominance. So where does all this leave us? The China BHP iron ore ban of 2025 represents far more than a commercial dispute. It's a manifestation of profound shifts in global economic power, resource nationalism, and the end of unchallenged Western control over commodity pricing. For Australia, the ban serves as a wake-up call. Decades of comfortable dependence on Chinese demand for raw materials may be ending. The country faces difficult choices. Invest billions in green iron and value-added processing. Accept reduced profit margins in exchange for market stability. Pursue aggressive diversification toward other export markets. Develop strategic partnerships with Chinese companies involving shared ownership. Each path involves trade-offs and risks. For China, the ban demonstrates growing confidence in its ability to shape global commodity markets. The establishment of China Mineral Resources Group, strategic stockpiling, investments in alternative supply sources like Simandou, and willingness to withstand temporary supply disruptions all indicate a sophisticated, long-term strategy. Beijing is systematically reducing its vulnerability to external suppliers while increasing its pricing power. For the global iron ore market, the ban signals increased volatility and uncertainty. The days of stable, predictable supply relationships may be ending. Expect more strategic maneuvering, more government intervention, more linkage between commercial transactions and geopolitical objectives. The shipping industry, already struggling with overcapacity in some vessel segments, faces additional uncertainty. Cape-size bulk carriers rely heavily on the Australia-China iron ore route. Disruptions to this trade flow have cascading effects through freight rates, vessel utilization, and shipowner profitability. Steel producers globally watch with concern. Stable, predictable iron ore supplies are essential for production planning. Market disruptions, even temporary ones, complicate procurement strategies and create price volatility that squeezes margins. Investors in mining equities face a new risk landscape. Traditional analysis focusing on production costs, reserve quality, and operational efficiency must now incorporate geopolitical risk, market access uncertainty, and the potential for state intervention in commercial relationships. Valuation models that assume continued unfettered access to Chinese markets may require fundamental revision. The diplomatic implications extend to the highest levels of government. Iron ore disputes become matters for prime ministers and presidents, not just corporate executives. Australia's relationship with China encompasses strategic competition, economic interdependence, and shared interests in regional stability, all complicated by the reality that iron ore represents the single largest component of bilateral trade. Could this ban become permanent? Unlikely. The costs to both sides would be too high. But temporary doesn't mean inconsequential. Even a brief ban establishes precedent, demonstrates leverage, and shifts the balance of power in future negotiations. What about other commodities? If China successfully uses bans to extract concessions on iron ore, might similar tactics be applied to liquefied natural gas, coal, copper, or lithium? Australian exporters across multiple sectors now understand that market access cannot be taken for granted. Strategic dependence on any single customer, even as massive as China, creates vulnerability. The role of Brazil's Vale in this situation deserves final consideration. As the world's biggest producer of iron ore pellets and Australia's primary competitor, Vale stands to benefit from any sustained disruption in Australian-Chinese trade. Brazilian ore travels farther to reach China, but Vale's production costs remain competitive. The company's announced $12 billion investment in the Carajás complex signals confidence that market opportunities exist to capture share from Australian producers. Could Australia and Brazil end up in direct competition for Chinese market share, driving a race to the bottom on pricing? Or might informal coordination between major suppliers maintain some pricing discipline? These questions will shape industry dynamics for years to come. As we look toward the future, several scenarios emerge. In the optimistic scenario, BHP and China Mineral Resources Group negotiate a compromise that addresses China's pricing concerns while maintaining reasonable returns for Australian miners. Market access resumes, production continues, and the relationship stabilizes under new terms. Australian miners accelerate investment in green iron and value-added processing, moving up the value chain and reducing vulnerability to raw commodity price swings. China's diversification toward Simandou and other sources proceeds, but doesn't eliminate dependence on Australian ore. A new equilibrium emerges with multiple supply sources, more balanced market power, and reduced potential for either monopoly or monopsony. In the pessimistic scenario, negotiations fail. China's ban on BHP becomes prolonged or even extends to other Australian miners. Australian iron ore exports to China plummet, devastating the Pilbara economy and eliminating billions in government revenue. China successfully transitions to alternative suppliers, particularly as Simandou reaches full production. Australian miners face a structural decline in their dominant market position, forcing industry consolidation, mine closures, and massive job losses. The Australia-China relationship deteriorates further, with iron ore disputes spilling over into other economic and strategic issues. The most likely scenario falls somewhere in between. Negotiations eventually yield a compromise that incorporates elements of both parties' positions. The ban is lifted, but under modified terms that give China more pricing flexibility and influence. Australian miners accept somewhat reduced margins in exchange for market access, but continue to benefit from their cost competitiveness and quality advantages. China continues diversifying its supply sources, but maintains Australia as a major supplier, albeit with reduced market share over time. The relationship becomes more transactional, less stable, and more subject to periodic negotiation and posturing. Regardless of which scenario unfolds, one thing is absolutely certain. The era of Australian iron ore dominance operating in a benign, stable market environment is over. The China ban of 2025 marks an inflection point that forces fundamental reassessment of business models, investment strategies, and strategic assumptions. Australian mining companies, investors, workers, communities, and governments must all adapt to a new reality where market access is contested, prices are pressured, and geopolitical considerations shape commercial relationships. The iron ore industry that emerges from this crisis will look fundamentally different from the one that entered it. Greater Chinese influence over pricing, more diversified supply sources globally, increased emphasis on green steel and processed products, more government intervention in what were previously commercial matters, and higher risk premiums reflecting geopolitical uncertainty. For those invested in Australian mining, whether as shareholders, workers, or citizens benefiting from resource wealth, the message is clear. Diversification, adaptation, and strategic thinking are no longer optional. The comfortable assumption that China will always need Australian iron ore on terms favorable to Australian miners has been shattered. What comes next will require innovation, flexibility, and acceptance that the golden age of effortless resource wealth may be ending. The final word belongs to the numbers that capture what's truly at stake. $120 billion in annual iron ore export value, 60% of Australia's exports to China, 263 million tons of production from BHP's Pilbara operations alone, 711 million tons shipped from Australia to China in 2024. These aren't just statistics, they're the foundation of Australia's economic prosperity, the livelihoods of hundreds of thousands of workers, and the fiscal capacity of state and federal governments. China's ban on BHP iron ore in 2025 isn't the end of this story, it's the beginning of a new chapter. A chapter where market power is contested, where pricing mechanisms are negotiated, where alternative supply sources reshape global flows, and where geopolitical considerations increasingly dominate commodity markets. Australian miners, investors, and policymakers must navigate this new reality with eyes wide open to both the risks and the opportunities. The question isn't whether Australian iron ore will continue to play a major role in global steel production. It will. The question is on what terms, at what prices, with what market share, and under what degree of strategic vulnerability. Those are the questions that will determine Australia's resource future in the decades ahead. And the answers are being written right now in negotiating rooms between BHP and China Mineral Resources Group, in investment decisions about green iron projects, in diversification strategies toward new markets, and in strategic choices about whether Australia remains the world's quarry or transforms into something more. This is the reality of 21st century commodity markets. Welcome to the new era of iron ore geopolitics. The ban is real, the stakes are enormous, and the outcome remains uncertain. But one thing's for sure, the Australian mining industry will never be the same.